Welcome, everyone. You're great to be out so early on a cold morning. My name is Roger Prince, and I'm a senior tax manager at BerryDunn, McNeil & Parker. We're a Maine accounting firm, really working nationwide now. We have about 245 employees, but our biggest offices are in Bangor and Portland. And you may wonder, well, it's the Affordable Care Act, and this says something about tax considerations. Why an accountant here? And the reason is this, that, and some people aren't aware of this, the Affordable Care Act is the largest tax act this country has seen since the 1986 Tax Reform Act under Ronald Reagan. It's an incredible act with respect to how many tax implications there are. And really, the reason that the Supreme Court found that it was constitutional with respect to the individual mandate was because it was a taxing feature. We're going to talk today mostly about small employer considerations, and for a large extent, small employers are fortunate, those under 50 employees, including full-time equivalent employees, because really there is no mandate. There isn't now, and there is not likely to be down the road. We work with a lot of large employers, and they're concerned because they're looking at potential penalties for lack of coverage starting in 2015, and small employers don't have that conundrum. What small employers do have, though, is a need to run a business and a need to attract and retain employees. And so what we're actually, at the end of the year, I was getting most of my questions from small employers, and primarily because a lot of their employees are not well educated on the impact of the act on their personal finances or their personal health decisions. So here would be a common question. They call up and say, Roger, I've got employees coming into my office and they're upset because I offer coverage and it's precluding them from going to the exchange and getting a subsidy. And that really was a common question. And what it pointed out to me was that a lot of employees just didn't lack the knowledge to understand what their employer coverage meant to them versus getting a federal subsidy at the exchange. So we'll talk a lot about that today. So we have up here the individual mandate. And really this slide is less about the individual mandate than it is more about the individual subsidy. And we bring this up because the ability for a person, an individual, to go to the exchange and procure a subsidy is one of the core elements of the act. And it's a tax element. It's like the advanced earned income credit, in essence. I, as an individual, depending upon a number of factors, can go to the exchange now, and depending upon those factors, maybe qualify for an advanced tax credit. And what will happen will be that credit will be based upon some assumptions that are made about my income and about my other status. And then at year end, when I file my income tax return for 2014, it'll all be trued up. And what a lot of people don't realize is if my estimations were wrong and I have been paid too much of a credit, I'm going to owe that back with my Form 1040. They will reduce any refund I have coming if I owe credit back to the government. So a lot of the arguments about the act in the Congress last year were about what kind of information is the IRS going to use in order to determine whether or not someone is eligible for a credit. And the biggest part of the information is income. What happens is, if I'm an individual and I want to qualify for a federal subsidy, then I can only earn so much. And the limits here, is what I want to point out, are quite high. For example, single 2013, it's almost $45,000. And I'll get to what kind of income this is. And in family, with a family of four, would be almost it's 94,000. And what we're looking at here is household income. And it's basically adjusted gross income, which is the bottom page of page 1 of your 1040. So it's your adjusted gross income with an add back of any tax-exempt interest in simplistic terms. But these are high income numbers, which means if I'm in a small employer and I've got employees, it's likely that a large part of my population may qualify for a subsidy based upon income. So I have to keep that in mind to some extent. The other item I need in order to qualify for a subsidy is that I'm not eligible for any kind of governmental coverage. Like I can't be eligible for Medicare, I can't be on Medicaid. And that's a big issue on this Medicaid expansion. Because if they expand Medicaid to 133% of the federal poverty level, that means a lot less people will be eligible for a subsidy, which is large employers would like to see. Finally, and this is a biggie, I may not be eligible for employer coverage, small or large employer, which is both affordable and provides minimum value. So if I provide affordable coverage as a small employer, it will negate my employee's ability to go and get a subsidy. And that's okay. That may be the best way to go. So, why would an employee even care whether or not they have coverage through a small employer or on the exchange? And a lot of people don't think about this, but the taxable nature of the benefits is entirely different. When I have coverage through a small employer, let's say you're providing group coverage, maybe it's, and this is very generous, employer pay all for single, but employee pay all for additional family. That coverage I'm providing my employee, that employer payment of the premium, is entirely tax-free. It's the largest tax benefit in this country. A lot of people don't realize that. They think of Schedule A, their mortgage interest deduction, or maybe their deduction for income taxes paid as being the biggest tax deduction, but it's really the tax-free nature of health benefits. And one of the things you see nowadays, that very, very large employers of 250 or more now have to report the amount of health coverage provided on W-2s, because the government wants to start understanding how much of a benefit is this. And so the employees are receiving a benefit from you, the employer, tax-free. Let's say the employer pays half the premium and the employees pay the rest. They're going to do that, hopefully, through a cafeteria plan. So they're going to do pre-tax premiums through a cafeteria plan. For both income tax and payroll tax purposes, those are tax-free. So in essence, what I'm thinking is, even for a low-wage employee, they're saving about 24 cents on the dollar when they have employer-provided coverage. Because for every dollar of coverage, they're saving about 25 cents in tax. Finally, if you have an employer plan, you can provide a health reimbursement arrangement, flexible spending accounts, or maybe you use a high deductible plan with a health savings account. Now, instead, I don't offer coverage, and I send my employees to the exchange. And you might be thinking, where does that leave them? It leaves them potentially in a good spot, because the biggest tax benefit of going to the exchange is they may qualify for a subsidy. But as we know, that depends on income. So if they're single and they earn more than $45,000, they are not going to qualify for a subsidy. Same thing if they're a family. That's a high rate, though, I understand. I know some employers are saying, well, I'm going to just discontinue coverage and I'll bonus out my employees some money and I'll let them go get coverage in the exchange, which can work, but that bonus is fully taxable. So you're providing a taxable benefit to replace a tax-free benefit. So you have to consider that. I just want to put these down as considerations. Here's a question we've had a lot. I'm a small employer and I make an offer of coverage to my employee where I say, I'm going to provide employer pay all for single coverage and employee pay all for family coverage. So that employee then goes to the exchange, and that employee is married. That employee, you and I know, won't qualify for a subsidy because they have an offer of coverage. Will that employee's spouse qualify for a subsidy? Anyone think yes? They won't. And the reason is that I have offered spousal coverage. And you may think, well, the spousal coverage isn't affordable because it's employee pay all. But that doesn't matter. Affordability, for purposes of the Act, is only dependent upon the cost of single coverage. That's it. Family coverage need not be subsidized at all in order to be affordable. And so what we're talking to some employers about is, think about this, you might want to discontinue spousal coverage if you're not providing any employer dollars. Because at least that way the spouse has a chance to qualify for a subsidy. Now when the spouse goes to the exchange, their subsidy will still be dependent on household income. So if their household income is over those limits I showed you, the spouse still won't qualify for a subsidy. But if their income is within the guidelines and you make an offer of coverage to the spouse, that precludes the spouse right up front. This is another question we've had. If you're a small employer and you're offering coverage, and this is more for large employers, but can I use an HSA or an HRA to make my coverage affordable? Or provide minimum value? And the answer is yes. You can see by the slides. In essence, if you're going to offer a health reimbursement arrangement going forward, an HRA, that HRA now, whether you're small or large, has to be integrated with a group health plan. It used to be that we had clients, and I'm going to get to a slide on this, offered standalone health reimbursement arrangements. And those are no longer going to be viable. Here's another thing we've seen a lot in the small employer market. It's where employers, instead of providing a group policy, would tell their employees, or a certain portion of their employees, go out and buy an individual plan and we'll reimburse you for it on a pre-tax basis. And that was perfectly allowable. It's been allowable for a long time. And what the government has said, they issued guidance last year in September, that you can no longer provide employer pre-tax dollars for an employee to buy individual coverage. They're not going to allow it. You can still provide them dollars if you want, but they're going to be includable in their W-2. So if you want to, what we're suggesting instead is, I just want to see if I'm not getting a slide ahead of myself, that if you want to allow your employees to buy individual policies, what you might want to consider is, let's say you have a segment of your employees, you got 4 or 5 key employees, and you really want to provide them some sort of pre-tax benefit. What we've been explaining is you could have them go out and buy individual policies and set up health savings accounts if the policies are high deductible health plans, and then you as an employer provide contributions to those HSAs. Now you have to be careful because there are non-discrimination rules with HSAs, employer contributions, but it's one way to maybe make that happen. You really can't use a standalone health reimbursement arrangement anymore. So if you have that kind of arrangement, you got to be careful and take a look at it. Again, here we are here. What happened was when the IRS issued this guidance, there was a lot of consternation because the guidance looked at health reimbursement arrangements, cafeteria plan, flexible spending accounts, and these employer reimbursement plans. And it basically said you just cannot do this anymore. You can't have a standalone plan providing reimbursement for individual coverage. So you really got to look, if you're doing that, you have to look at it because this rule is effective as of January 1, if that makes sense to everyone. There are exceptions, like there may be some sole proprietors here. Sole proprietors can still have standalone health reimbursement arrangements and so forth. And there's again our idea at the bottom of using a health savings account with a high deductible plan and maybe allowing certain or encouraging certain employees to go that route. Does that hopefully make sense to people? Moving on to that small business healthcare credit. This wasn't in my slides the last time I did this, but it's a big topic today, and I want to be honest, we don't see employers use this credit that much, probably because the bar to meet its standards is pretty high. But it's a great credit if you can meet it. As you can see by the notes, it used to be that your maximum credit as an employer was 35%, and that's now increased to 50% for the year we're in right now, for 2014. There are really 4 conditions. You have to be a small employer, 25 employees or less. Your average annual wages have to be under $50,000. That's average annual. And this is one of the big stumbling blocks, the employer has to pay 50% or more of the premiums. That's a pretty high employer contribution rate. And finally, and this is brand new, and Mitchell mentioned it, if you want to take advantage of this credit starting in 2014, you have to use the new exchange shop program. So that's brand new. But we do believe it's a good credit. Let's just take a look at it in a moment, what those different standards meant. We talked about the number of full-time equivalents. And basically, what you do here is you can see that you just basically divide your total annual hours by 2080, and that's your FTEs. And it's like a lot of these rules, they don't look at certain overtime hours and so forth. You lop off hours earned in excess of a certain amount. And the big thing is excluded employees. You don't count owners and their family members. There's family, they call it attribution. You attribute ownership to various family members, and you don't count seasonal workers either. So that's how you determine your full-time equivalents. And then your average annual wages is pretty much as you would expect. You take your full-time equivalents and you divide, and you round down to the next $1,000. Again, I got to move my slide forward here. And by the way, it's an important little point here. The relevant period for that tax credit is not the calendar year, it's the employer's tax year, which for small employers often is the calendar year, but it's not always that. It's a sliding credit. So the most you can get, the 50%, is when you're at 10 full-time equivalents. As your company gets bigger, up to the 25 limit, the credit's going to become less and less and less. Same thing with average annual wages. So the largest credit is for very micro employers, 10 or so. There we are with me, pre-beard. Are there any questions on any of that? Yes, sir. Well, at least for the time being, for the next 2 years, the credit's in place. And I know what Mitchell was mentioning, that the way the SHOP program is working is as you exceed the initial number of 50, you can remain on SHOP, but that's not the way that credit works. I mean, you do phase out once you go over 50. But I don't know if the credit is going to stay At least for the next 2 years, it's here.
So the way the law is currently written, it is available for 2 years on the marketplace. So if you've been collecting the credit until now, that doesn't count. The clock ticks when you start offering a marketplace plan, and so you'd be eligible for 2 years worth of that credit. Whether you did it in 2014 or you do it the first time in 2015, you'd get 2 years worth of credit.
Okay, excellent. Yes, sir. Yes, it could be the same insurer, you're right. It's a process more than, you're right, than anything else. And as you know, Mitchell mentioned, the shop process for 2014 is different than it's going to be going forward. I mean, the full shop is not in place yet. You have to do it this year direct through a broker. And you're not going to have the availability of using multiple insurers until 2015, which is really the dream behind the whole thing. Yes, anyone else? Yes. What's considered affordable health care? That's a good question. What's that? Well, I can do as far as, I think from a tax viewpoint, I can tell you what the affordability standard is. What happens is, because I didn't have a slide on that, in order for my employee to be precluded from qualifying for a subsidy on the exchange, I, as a small employer even, have to offer coverage that's affordable and that meets a minimum value. An affordable coverage basically means that the employee's premium cost, if there is any for the employee, is not more than 9.5% of their household income, okay? And that's going to be a different number, obviously, depending upon the wages of the employees. Where we're seeing affordability come up is with lower paid employees. Minimum value means how much does the policy provide for benefits absent the deductible and out of pocket. A 60% minimum value standard is what's in place. That's probably not going to be the issue. Like Mitchell mentioned, Maine has always had quite generous health insurance. It's really the states down south that had a big deal with minimum value, and as a result, their premiums are going up. In Maine, the premiums haven't been a big jump because the policies were already designed this way, but the affordability is an issue, you know, in some places. Does that make sense? Wrap up. Okay, there you go. Wendy's great about this. I'll be here too after this, and I'll be right on through the session.